Okay, hello folks. Welcome to Market Trends. I'm David Russell, Global Head of Market Strategy at TradeStation. It's great to be with everyone. Do these webinars every every Thursday afternoon at 2 p.m. Show you some disclosures to start. Very interesting set of events and price action in the market right now. Let me just do one quick thing here. All right, good. Now, as usual, if you go to tradestation.com and you click on Insights at the top, you will see our um, normal blog post that includes a lot of interesting information that we're going to be covering today. So if you want to do that, if you're here on tradestation.com and you click on Insights, then we have this blog post right here. And we have some other information we're putting in. We're actually going to start doing a webinar on Monday afternoons when we talk about kind of the indexes more and we focus on the sectors in the S&P 500. And then on Thursday, we're going to be focusing on kind of the news and events that are happening. So we're going to start doing two next week. If you want to check it out, the link is here at the top of the blog. As usual, we have right here our zip file. In that zip file, it includes the link to some workspaces and some easy language documents with indicators that you need to load first for some of those workspaces to work. And also our trading view ideas are here if you want to check those out. I'm going to actually show you briefly one or two of those pretty soon. First, I want to start off by showing you the standardized returns of some ETFs. I'm going to share in the chat some disclosures, including a link to the prospectus page of these ETFs if that is of interest to you. All right, great. Now, very interesting activity here in the market overall. Let me just start off very quickly. I want to start um, because there's so many interesting things here. I have this. The very first thing I'm going to start with this radar screen because this radar screen basically. I wanted to just look at these here. What's really interesting is if you look at the first half of the year, this is set up to show the. Wait a second. Am I sharing my screen? Yes, good. All right, this is it right here is what we're looking at. This can show us that in the first half of the year, the Nasdaq was up 14%. It's down 3% in the second half. So we're just looking right here at since the beginning of July. And what's interesting here is if you look at this, you can see that the Russell is up 9%. It was down in the first half, and now it's leading in the second half. Banks are now up almost 10%, which is beats their entire performance in the first half. And you can see semiconductors were the big leaders in the first half, and now they're down. So the big point here in the title to our article is, the rotation intensifies. And we've been talking about this rotation now for a little while. We're not the only ones, of course. It's been a very common theme. But the fact is that this is something now that has been kind of happening, and I'm not sure if even in the near term it's exactly where the focus should remain for us or not. But the key point is that this helps to illustrate it. And this thing is called two period changes. We showed you how to. We have included this in the zip file, and I'm going to show you. Actually, in today's blog post at the bottom, we show how to set up this little radar screen. And the key thing is what we did was we set the interval to monthly. That's the key thing. You can do a lot of interesting things when you use different time frames on radar screen. You can set up the weekly, monthly, hourly, things like that. And what this does is we also set it up to a time frame that would look at the first 6 months of the year versus the current month of the year. So this is something you might just kind of find useful. It can be especially interesting around things like a half or a quarter or periods of time that could match up to investor rotation periods. So this is something that we've been kind of watching, and this radar screen helps to illustrate. You can also see here what's very interesting is the real estate investment trust ETF was the only sector that was negative in the first half, and it's now up 4%, 4.5% this half. It may actually be the top performer. I'm not sure if it's the top performer Actually, I did have this here. No, I don't have that. It is the top performer potentially so far in the second half after lagging in the first half. We can actually see that now if we go over to MT main and we go to key ETFs and we now look at our spider funds and we look on a year-to-date basis, and we can actually see, for example, that on a year-to-date basis, interesting, financials are now leading. How interesting. Um, and then we see here, yeah, real estate, you can see here is still on a year-to-date basis, a laggard. What we can do is we can copy this over like this. This is our list of spider funds. Bring it back over to this radar screen. And just very quickly, I can go down here and I can paste this in. And what this will show me is so far in this period, yep, now look, see the financials just moved ahead of real estate. Nonetheless, you can just kind of see here the way this is kind of playing out, and you can compare very strongly. You can see these names that were really strong in the first half, communications and technology, are lagging here. So that was just a big thing here. Now, before I get on to some other things, I want to just very quickly look at something with the S&P 500 because we have some interesting things happening here, as I think everyone knows. But what's interesting is we have this level back here from June 13th, and I think that's really at this point a level everyone's looking at. The 50-day moving average is also on this. It's right in the same area. I don't have it on this chart, but now we have some levels here, and we had this kind of price zone in basically late June through kind of the more or less the second half of June, this price range, and now we're kind of holding it. So I think this is something that is technically a confirmation at this point in time that with this pullback we still have the structure of an uptrend here. This is it's not even back to its lows from last month. So on this basis, if you think about it on like a monthly basis, we're still at this point holding more or less the midpoint of June roughly, which is consistent with that sort of still intermediate to long-term uptrend. And if you look at this now is a potential ABC kind of correction, but now you can see that this is potentially having completed itself. What's interesting here is we have a false breakdown where we went down under that level and we came back. So that's actually something that's potentially also a sign that the selling got exhausted there. Now, what I think is really interesting is if I look at this, is that we have some things technically that jump out to me. And the first one is going to be the semiconductor index. Let's actually look over at this other. I go to MT main. Sorry, too many workspaces here. Go to $ SOX. Philadelphia Semiconductor Index went down and it went under this level from the end of May and basically held. So I think right now we're at a spot where this has really gotten a pretty extreme sort of sell-off. And I think now we have to kind of realize that, it's nice to see things like the small caps and the banks and those things kind of doing well. But at the same time, risk here of things like the semiconductors and some of these tech names, having something of a rebound from here and potentially just kind of changing some of this thing. This rotation story has gotten very common at this point. I'm hearing it a lot, and I think we have to realize there's a lot of arguments in favor of it. Nonetheless, there is that situation where people can start to say, "Wait a second, the big names report soon." And they've a lot of them have pulled back significantly. By the way, if you want to see when companies report, we go to earnings dates here on our MT main workspace, and we just bring in. I'm gonna just go here to data, add symbol list Nasdaq 100, and I bring those in, and you can kind of see it'll populate in the background as we talk. But remember, that's how you can do it. You can build your own earnings calendar very easily here using radar screen. And let's kind of go on now. Um, so I mentioned about the socks, and Nvidia is such a huge part of the socks now. And if you look at Nvidia, and if you look at Broadcom, so again, what's interesting here, I think with Nvidia is if you look, this is like it's so similar to what it did earlier in the year. Hit an all-time high at a bearish outside day of reversal. Came up a few weeks later, made a slightly lower high, and then it kind of staggered, and then it kind of had a dump that lower, held, and that was it. What's interesting here is it looks so similar. Where basically it even hit the 50-day moving average. It kind of comes down, lingers at the 50-day, plummets, holds, and then recovers. Same thing. It's so similar. Bearish outside day at the all-time high, slightly lower high, comes down near the 50-day, pukes below it, holds, and now let's see what happens. But I think we have to realize we could be in a spot here now where after this kind of carnage we've seen in the big cap technology stocks, um, this is an area where people might start to think, this is something that has some opportunity, especially because we have some potential patterns today. Like I mentioned, in particular on the stocks, this is basically well, not in well, there was some bearish out. There was some bullish, some false breakdowns here. And maybe it was Nasdaq. I'm sorry. Just kind of seeing here where basically we have, you know, this level from back here. We have these long tails, which suggests a kind of bottoming process potentially. People having stepped in, and this is a potential sort of bullish reversal pattern where people can say this pullback that has lasted about 2 weeks. Now we have a signal that it might be over. So I think we have to realize as people look at these charts now, they might start to say some of these growth names actually are potentially starting to give some signals. So I wanted to point that out. In particular, Apple. We talk a lot about the Keltner channel. It's a useful indicator. And here it is, Apple down at the bottom of the Keltner channel. We also have Apple holding these highs from back here in mid-June. I think this is something that also is something that people might start to view as a potential opportunity. Apple had this breakout and they did their AI thing. Another thing we can look at is we can go here to our drawing tools. We can go to Fibonacci price. Where is it? Fibonacci price retracement lines. If we kind of look at where it was, say, for example, the close after the AI news, it has now retraced about half of that. We could also bring it back to its close before the AI day. Still around the same thing. It basically has held a 50% retracement of that rally. These sort of things might start to jump up and catch people's attention. So I think it's important for us to realize now that, yes, there has been a rotation toward other parts of the market, but we also can, at the same time, I think just have to remember earnings are coming out on a lot of these names, and there's a point where some people might start to look for opportunities in these. All right. So as we look over at our rundown here, which is right here. All right, I'm gonna hide myself so you can see this. Um, now, um, the S&P revisited its level from mid-June, as we said. And basically here you can see in the price chart, went down, basically broke under that 50. It was 5402 was the low. Today we went down a little bit below it, but we basically held 5400. And I think that's at this point, a spot where people are going to consider the level's been tested. At least for now, it's holding. And that might be something, like I said, that is that sort of short-term bullish reversal pattern potentially that can signal that the last 2 weeks of downside might now have been kind of halted. What's interesting also is that we had a real reset on things like RSI. So one of the things I have watched and is the let's go back over here. The RSI, it has basically gotten down, significantly after being overbought. And what we saw before was when RSI hits overbought, it gets down a lot, but it doesn't go all the way to oversold, and then it kind of, you know, if it were to stabilize here and not get much lower, that could actually be a bullish pattern because what we've mentioned is the way that RSI is actually a signal of strength. And if you consistently hit overbought and then don't go to oversold, that is actually a sign of the fact that that we have overall a kind of bullish situation with the kind of intermediate term trend. And I think it's really interesting to see this because, like I've said many times, this resembles 1995. I mean, there's so many things about right now that resemble 1995. I don't want to get into politics at all, but in some ways, even you can start to see the political environment could resemble something like 1995. The Fed can resemble 1995. The soft landing, the RSI, all these things have so many similarities right now. And I think we want to just kind of remember that. That was, one of the most interesting technical bullish streaks of price action in 1995, where the S&P had a really strong and steady uptrend that marked the beginning of this. Maybe not the beginning, but it marked the intensification of a secular bull market. And we seem to be in something similar at this point in time. I think we have to keep that in mind. All right, so the index basically pulled back, probably if you go all the way from the high to the low here, because we did move lower today, but basically it's about maybe 3.5% off the all-time high, which if you think about it is a very kind of modest pullback overall. And I think it's also interesting here that, it's, okay, just look at this line. You can just see this here. But, like that's sock. It was a little bit more than 3% the um off the all-time high. So anyway, that is also something where if we stabilize here, that is really the sort of thing that is consistent with more of an uptrend, which is essentially that things get kind of bad, but they don't get really bad. There is not that continuation of selling. And that is the sort of thing that can suggest, again, like we've said about this market, there are simply not a lot of sellers. And in fact, there is some interesting evidence that came up for that today. So if you look at the American Association of Individual Investors, and you look at their survey of bullish sentiment, what we actually saw was we saw that the bullish sentiment dropped 9.5 percentage points between last week and this week. Last week it was getting giddy. It was at a relatively high level historically, as we discussed at the time. And now it fell a lot. And the actual drop in a percentage in basic simple percentage points was the biggest drop since February of of 20 of last year. It was about a year and a half now. So basically, one of the things about this market is that what we see is we see people get skittish really quickly, and that actually means that again, people are not complacent. They're not just having just sheer confidence. And the thing is, this is still symptomatic of the earlier half of a bull market, of a bull run, than the second half of a bull run. In the later part of a bull run, people are more complacent, and you don't see the same kind of when people get scared and kind of run away from the market. But what's interesting about today's AAII is it continues to reflect that kind of skittishness, which is consistent with a wall of worry, which is consistent with the earlier stages of a bull run, potentially. Now, another thing that was interesting is I just look overall, and we've just seen. All right, let me just. You can check some of these things out that we had written about. We talked about how it was the first 2% drop in 356 candles or days or bars or whatever you want to call, the history. But the basic thing is that was the long. We had just ended the longest streak since February of 2018 without a 2% drop. And if you actually click through here, it takes you to a blog post we did that actually explains a lot of the easy language and the custom indicators to go through. We actually go through line by line and explain the indicator. It's kind of cool. And one other thing I'll just mention is, with AI now, it's possible for you to have AI help you code easy language. And it's one of the things I do as well. So it actually means that some of this functionality that TradeStation has had for a long time is actually getting easier to use as technology kind of comes along and helps it. So I want to just mention that easy language is now more accessible, and it's an exciting thing. I think we should all kind of think about and be happy about. Anyway, I shared that one earlier in July, and it's interesting that now it basically triggered a 2% drop. Was yesterday. All right, now we have talked about this rotation. We kind of mentioned it here, but it's also interesting that we have seen healthcare do some interesting things. And I've talked for a while here about healthcare is in an interesting spot because one thing we have some movement today. It's the upside in biotechnology, but like I've said, healthcare is a part of the economy that is not. It's surprising because forever you heard people say healthcare is going to be a growth part of the economy, and now nobody talks about it. Well, if you look at today's GDP report, they actually mentioned that healthcare is one of the drivers in the economy. So that I think is interesting. So my point is that right now, if you look at, we did this idea on TradingView, and I'm going to show you. here on TradeStation. We look at the XLV. The XLV here is just kind of breaking out to new all-time highs. Now, this is not a very fast-moving or exciting index, but it is interesting to see that this is now, has basically just moved kind of sideways for a long time. I mean, it really has not done very much since back here in like 2021. So it's like 3 years now of sideways movement, and it's just trying to kind of break out. At the same time, people are rotating away from some of the bigger areas and parts of the market. So I think what's interesting is this is an area that is in a secular growth phase, and it is a respectable mainstream part of the market. It's not something that's a speculative or has a lot of weird issues with it, like the way you know banks used to, or anything like that. This is some of these are major blue chip stocks in here, like United Healthcare, Johnson and Johnson, and stuff like that. What's also interesting is now these are not stocks people trade a lot, but HCA and UHS. These are hospital operators, which are kind of obviously a key point of sales for the healthcare industry in various ways. Monster earnings on both. Very interesting. And this is consistent with the pattern we saw before, which was more utilization of healthcare, more demand, more activity, more stuff getting done in the healthcare space. Now, this was a problem for the health insurers earlier in the year because people were spending too much money, and it hurt their payout ratio. I can't remember what it's called. It might be called it's like their combined ratio, but basically when people use more healthcare, they have to pay more, and that's bad for their earnings in the short run. But the key thing is that it's a bullish problem, it's a happy problem essentially for the industry, because it means that the industry is being utilized more. So I think right now, when we see what's happening with things like the hospital stocks and things like that, we see healthcare quietly breaking out. To me, this is something that could have some interesting implications going into the rest of the year. And I think we just have to realize that we have written at different times about the massive concentration in large cap stocks. A lot of people have done it. But the thing is, if we have reached that high watermark in terms of where large cap stocks are, then the problem, or the mega cap stocks are, then the issue is, even if they do well, there could be a gradual migration back to other parts of the market. And in some ways, based on the things I said, healthcare could be a spot for that. So I want to just kind of point this out, because there are some areas here where we are getting confirmation, I think, when you look at these earnings reports. We just kind of look through. I mean, I want to just mention that some of these things were just some interesting data. Today, the GDP was way stronger than anyone expected. And what's interesting is the prices continue to kind of moderate. Earlier, we had this report from S&P Global. This is worth looking at, because this report has been pretty accurate now. And they were talking about slower price increases. They actually said the word Goldilocks in this report. This is the S&P Global, PMI data. It's free to get, and it also comes out before a lot of other data points. It's similar to like the ISM, this Institute for Supply Management, but it comes out a week or two earlier. And they have been accurate on certain aspects of the economy. They were saying earlier in the year, no recession. They were some of the first people to say that. They've been pointing now to lower price pressures, and then boom, what do we get today? We suddenly get this positive sort of surprise on GDP. Remember, this is GDP now from the Atlanta Fed. We had a big drawdown in GDP estimates here, a big drop. Basically, the outlook for according to the Atlanta Fed went from 3% growth to basically 1.5% in the second half of June. There was a big expectation of slowing economic strength. We saw a big increase in initial jobless claims, but then what happens today? Suddenly we get the jobless claims. They're lower than expected. Continuing claims start to come down. Continuing claims had gone up to a high level. So we had a period here where it kind of looked like maybe we're going to be soft, and then suddenly, boom, GDP comes out and it blows away the numbers. So I think this is actually just kind of what we're seeing here, where there's no stag and no inflation, or the inflation is fading and there's no stagnation. So again, all these things are kind of confirming and pointing in that same direction at this point in time. And I think like we saw the retail sales with the upward revision in last couple of weeks. So these things continue to point to an environment here where we have, healthy spending, moderating inflation, and a situation where the Fed is positioned now to be, lowering interest rates in September. So again, when you look at that that out the overall backdrop that we have right now, it is a pretty constructive one overall. These things do remain in place. Now, we had actually done a trading view idea when we looked at some of these things. We did this back, I think on Friday, and what we did was we looked at this the as we did this on Monday, and the we looked at the semiconductor index. We looked at our broken support, and then at the same time, we looked at this breakout in the banking index, the KBW banking index. I want to just point this out on this weekly chart. We can actually see it here. We go to I think it's BKX. I think is the ticker on TradeStation. And if we take we look at the weekly chart, you can see here that we kind of took out this level. So this was Silicon Valley Bank going under, blowing up. And so I think it's important here to realize that, we've talked a lot about this pattern of when you close at a weekly high for like a major index, it has when the weekly close is the highest in a longer period of time, a year or more, it has been followed by follow through, bullish follow through. So look at XLV, for example, very similar sort of pattern. 2 weeks ago, it closed at an all-time weekly closing high, and then basically it just consolidated and now it continues to the upside. Something like financials, they were similar. They were not exactly the same. They actually had this kind of false signal right there, in mid-May. But you also see, something that's very tight overall. If you look at this pullback, went from like 42 and a half to like 40. Very modest pullback, and then you see them just kind of just the tightness of this, and then they just kind of escape, and now we have a bullish inside week even on the XLF. So this, I think, is overall just, again, financials and healthcare. These are like the boring industries that people were not buying for the last 10 years, last 8 years, when they were buying the growth names. First they were buying all the e-commerce and the data center names, and then that trade morphed into the AI trade. And again, the mega cap growth names have been the main thing. But now, if we have reached the high watermark on that, and there's migration somewhere else, the two sectors that might benefit the most could potentially be financials and healthcare. There could also be something in consumer staples, but I mean, that's a sector that overall is not usually very interesting. But I think when you look overall at some of the data we've seen about growing populations and other things like that, the consumer staples, this is Coca-Cola. But if you look at XLP, for example, this is also something that has been just kind of inching up with this very tight sort of consolidation here. And I've been kind of watching this, thinking this could be an area that does start to kind of do well. But it's just like, I mean, it doesn't necessarily kind of perform in a bull market. But I think it's interesting to see the consumer staples even are starting to sneak towards some old highs. The one that grabbed my attention was Coca-Cola, which I'm going to get back to because this might be actually something that could give us, people looking for some potential option trades. Coca-Cola is actually on pace for its highest weekly close of all time. If it holds this level, basically through tomorrow, it would be a record weekly close on Coca-Cola. If you look at this also, this is like about a 2 year range going back from April of 2022. So this is now something also where it has had a long period of time to kind of go nowhere, and this could be something that also could potentially be a name where people would look for it to reset to the upside. Obviously, a mainstream blue chip name in the world of overall of the economy and the stock market that has not participated. And if, like I said, if money shifts from Nvidia and these other names, sort of these consumer staples, even some of them could potentially do some stuff. I was looking at Procter and Gamble recently as well, and Procter and Gamble also just barely sneaking to new highs. It's like, oops, don't even notice. It's just quietly just plotting to new highs. I'm not really as sure about Procter and Gamble, but Coca-Cola really grabbed my attention recently. When you look at the way it rallied here, and it kind of look at how it held above this high from June 6th. It just kind of held there. The 8-day exponential moving up. This isn't. We're going to be getting back to this one. All right, so I want to also mention, I do think we have to kind of remember that we have coming up. Um, there is this event. All right, there's two things on the 31st. We have the Fed meeting, and we have on the 1st of August, we have the OPEC Plus meeting. These things are hard to know exactly how they work out, but usually they happen like overnight because these guys are over in like Saudi Arabia and Russia and stuff. So this is normally going to be something that you can kind of view as Wednesday night sort of thing. But the thing is that they are expected to increase oil production, and oil's kind of trying to hold in there some, but we might have a situation here where oil essentially. I mean, if you look at this here, it's been making these lower highs. And from my perspective, this is something that people might be looking at some point for this to kind of continue lower because if you look at the Chinese data, it has not been strong. There's been a widening awareness now of China exporting deflation. China's trying to cut rates, not really working, and in terms of stimulating any kind of demand or anything. And I think this is another thing that is just a really potentially positive environment for stocks overall, not for precious metals, not for commodities, but just plain old equities. And I think that's the interesting thing here is to kind of see, copper weak, silver has just it was strong, and now it's just not performing anymore. Again, I mean, this was one that had this really strong move and then just has lost its mojo and all these things. Let me look at copper. So I think right now, when you put it all together, it is basically giving us a sense of a deflationary Goldilocks environment, and that is not good for crude. And I want to just point out there is that catalyst next week, and if we get to a spot where people start to be more negative on something like crude oil, I think we got to remember that event right now because that could be a potential opportunity. Don't forget, TradeStation recently lowered its day trading margin rates on energy products like crude oil. So it's something that you might want to check out. We did an article about it recently on Market Insights. All right, let me know if you guys have any questions. You're going to put it in, and now something I want to do is so we showed you the way the key ETFs. By the way, this is the earnings dates have now populated, and we have our average option volume here, which allows us to kind of see the names that trade a lot of options. It highlights. You can adjust the threshold for making it highlight, and it allows you to kind of scroll down your list and see. Okay, here are the big names. I don't care about CDW, but I do care about Meta. It just allows you to highlight it. Now these tools are all included in the workspace that we gave you guys. So go ahead and check that out. Remember though, you need to import the ELD files that include the indicators like this average options volume indicator that gives you a highlighting kind of functionality. You can also double click on this and basically select the ones that trade a lot of options, and then you can you can do something like put in a label row. You go to data, add label row. Now you're basically breaking off, and then you can go. You're basically excluding the ones that don't trade a lot of options, and now you can just look at them and say, all right, who's coming up next who trades a lot of options? You can just see here, on Semi, AMD, Microsoft, PayPal. It's all really easy to see when you use these different functions that are built in to into Radar Screen. Now, of course, like we mentioned, you can just see here that there has been, if you look in the last week, there's been this real strength in the small caps. There's been this real weakness in the semiconductors. Um, you know, the value is outperforming growth by a pretty significant margin. It's interesting to see things like healthcare doing very well as gold getting crushed. So I think overall, all this is kind of telling us a fair bit that. Let me hide myself because I think you can't see everything here. But the key thing is it's continuing to tell us that we are seeing not only um, a move to small caps, but we are seeing a move to other parts of the market. But I think what's most interesting is the weakness in something like gold. I think this is it's funny, a Goldilocks environment is not good for gold. We can also see here that we have this incredible outperformance in things like the regional banks, home builders have been strong, and now biotech is starting to come along as well. So all these things here, I think, are telling us a lot. However, we do have to realize though that we do have a potential bullish hammer on the semiconductor index. they are, that we have a potential kind of, signal that people might be starting to look for a bounce soon. So I think we need to at least kind of, bear that in mind. Um, Now, the other thing Another thing that mentions that matches kind of what I said about the skittishness in the market was there was an article from Bank of America saying that last week had the most stock outflows since 2015. So again, this is similar with that sort of thing of people suddenly get scared and they jump quickly. And again, that is, more symptomatic of the first part of a bull market than the second half when people just, I don't care, I'll just borrow more and keep buying. That's the way it is in the latter part of a bull market. So all these things kind of point a similar direction. All right, now this I think is fairly self-explanatory using the platform. If you want to look at that, I just wanted to mention that this is it was really useful for helping me to kind of show the divergences in the market between the first half and the second half. Another thing I want to point out is our MT breadth workspace, which we also include for you guys. This shows the internals of the S&P, the Nasdaq, and the Russell 2000. So it's interesting if you look here, you can see that more than half of the S&P 500 members are above the 50-day moving average. And in fact, yesterday you can see that 230 of the 500 companies were above their 50-day moving average, and then today that went up to 343. But that just kind of shows us that most of the companies remain above the 50-day. But what's interesting also is if you compare it to something like the Nasdaq, you can see that fewer than half of those companies are above the 50-day moving average. This is another sign of the sort of less strength in the Nasdaq. If we look over at the Russell of the 2000, we can see that something like 1,500 or above the 50-day moving average. So we can see that with these custom indicators here. The red line is the number of companies in the index above its 50-day moving average. We can also see that the advanced decline line in the Russell has been more or less hitting new highs. If you look at the Nasdaq, it's not hasn't really made any new highs since July 16th. Now let's look over at the S&P 500. It's pretty close to its high for the advanced decline line. So I think the all-time high on this one was 50,400, and we're back kind of within 100 of the all-time high on the advanced decline line. So again, this is kind of showing us that there is that broadening out, and these tools are also included. Just if you want to check them out, this workspace is one of my favorites. It's one of my masterpieces in terms of creating workspaces. I'm really proud of this one because it kind of allows you to see so well across the three indexes. It has a radar screen that highlights similar sort of things. You can see, for example, that in the last month, the equal weighted index have been outperforming over most other time frames. You can see that the SPY is outperforming, which is the market cap weighted. So this also is kind of consistent with that. All right, let me go. There were some other names that just kind of grabbed that were my attention that were kind of interesting here. One of them I mentioned HCA. I mentioned Apple at the bottom of the Keltner channel. Now, what's interesting is remember, if you go over here to our price grid, I think it's on here, and you have the Keltner pullback. If you look at something like Apple, you can see that it's down, relatively near the zero mark. This shows where the price is within the Keltner channel. So remember, if you want to look now and actually see where are some of these stocks in their Keltner channel, you can start to actually see who's most oversold and things like that. And I think it's kind of interesting here if you look that you can see that NVIDIA is just below the bottom of its Keltner channel, which is this dotted line here. And then a stock like JP Morgan is basically above the halfway mark of its Keltner channel because it's at 58. And basically 100 means you're at the top of your Keltner channel. Zero means you're at your bottom, but you can also be, above or below that. If you look at, other stocks, it might be 200, which means that you're way above the top of your Keltner channel, or it could be like minus 100 or something if you're below the Keltner channel. But these are just some tools you can use to find those sort of stocks that may have, maybe at the lower part of their ranges. The Keltner pullback is a custom indicator also that we've included in the workspaces for you guys to use. Another thing that was interesting right now, let me actually pull up this. I need to just mention this because um, if you look at the this is the yield curve. And you can see the yield curve is really steepening here. What does that mean? It means that 2-year treasury yields, and I can actually pull up this thing on TradingView and show you, 2-year treasury yields are coming down. And that's an indication. If you look at US, what is it? It's US, sorry. It's US 02Y. This is on TradingView. But anyway, this is a yield. This is a weekly. If we change it to daily, you can see this has actually been dropping more aggressively than the 10-year yield. The 10-year yield is just lurking below a key level right around 432. It's just sitting there. And I want to just kind of point this out because we have a bunch of events coming up like PCE tomorrow. We have some more economic data like that could potentially matter. For example, this there are some other data points coming out next week that could have a certain impact on on interest rates. There's going to be the unit labor cost. I didn't put it on here, but it is a potential catalyst. So anyway, these things also I think are interesting to realize is that everything we're seeing in the treasury market, which is not terribly interesting, is consistent with that move toward lower rates. All right. All right. Now I want to very quickly just remind you if you want to look for other sort of things using these workspaces, which we have for you, things like price grid can allow you to, we can just bring in now, for example, to keep it short, I'll putting in the Dow Jones Industrial Average. And you can see here that within the Dow in the last month, the best performer is United Healthcare. How about that? The worst performer is Nike. Wow, Nike's down. I can't believe it's down that much. Man, I can't even believe it's still in the Dow. I mean, I never I never thought Nike should be in the Dow. Just didn't think it was important enough of a company. It was anyway, um, Nike and Disney, and this is interesting. I don't think it's all that meaningful, but it's interesting just to kind of look and you can see how the price performance is changing. Interesting move today, like an IBM, but you can use things like Keltner pullback to be finding these opportunities. You can also look, for example, you can just use these to rank performance over different time frames. If you go to MA tools, just a quick reminder, you can go in here and you can bring in the symbol list like something like I'll do the S&P 500 real quick, but it allows you to see stocks that are doing things like pulling back to a moving average. Um, and another one that I'm not going to get into now, but you can use this to see how long since a moving average crossed, something like how long since the 8-day exponential crossed above or below the 21-day, how long since it touched the 50-day moving average. That's what these indicators do as well. So these are also available to you in our workspace. Now I'm going to get some the options chain in a minute here. So you can see, for example, this tells us, for example, that Intel today pulling back and touching the rising 50-day moving average. Not much of a, I mean, this name is this is something that struck me as just kind of. We actually said last week that this was something that was overbought based on news. Anyway, um, this kind of just highlights how you can see different opportunities. I often look for things that are kind of holding the 21-day exponential moving average. It's interesting that we do see actually Morgan Stanley kind of hugging along there. Another one of these kind of large cap kind of blue chip names that is not a tech stock that also hit a 2-year high here. We did a trading view idea on it earlier in the week, and it's just kind of holding above the old resistance level here. So Morgan Stanley is also something that kind of grabbing potential attention today. Now let's take a look over on Option Station Pro. Let's start off with Coca-Cola. Actually, I'm going to do is, you can see I have my symbol linking set to cyan. If I bring up, I'm going to set this to cyan as well on my Option Station Pro. And I'll go back to, by doing that, what it will do is it will ensure that a stock I'm looking at will come up and automatically populate here because it links the symbols between the two. So just remember that functionality. And what kind of grabbed my attention as my Coca-Cola here is this might be a name that people want to look at from a perspective of something like a calendar spread over time, where essentially what people might look to do is if they do believe that it has the potential for a longer term move to the upside by essentially owning long dated calls and selling shorter dated calls. If they target a strike that's out of the money, what they can do is over time, they can roll the position multiple times, letting the short calls they expire that they sell, those can expire, and then they collect premium, and then they sell more, and they collect premium, and then those can potentially expire. So the idea is when a calendar spread is you target potentially a level to the upside for a bullish one using calls, and then you sell short-term calls against it to bring in premium over time. And then eventually, if price gets near that level, you can start selling higher strike calls, which would have a higher premium based on the fact that the price is higher, and then you're lowering the cost base of the longer term calls you own. So, for example, a person could look at something in this case like the January calls at something like the what I was looking at was something that was like far enough out of the money that it might not get hit in the next few weeks. So something like 75 and a half, a strike like that, if a person would have looked to buy something around there and then sell something a month out, that might allow them to capture premium and then at the same time, have the long position. So let me show you how that could potentially work. If a person looked at this, they could click on the ask, which would simulate buying it would actually create a potential buy order on that. But then if we come over here and we look at the this expiration in August, and we go now to the bid, that's going to represent a sell. So a person can hold down the control button and click on that bid, and that's now going to say a person would buy the Januaries and sell the August. The net cost would be $1.88. By doing that, they would cut away more than 1/10 of the cost. About 15% of the cost of the calls would be offset. Now, the thing about a position like this is you can see that the delta, these have 52 delta and these have 28 delta. So even if the stock moves higher, what's going to happen is um, um, even if as it moves higher, the calls that they own will appreciate more quickly based on delta. And then also, these have more time decay. So these are only 36 cents, but they basically have a theta of 2, which means they're going to lose 2 to 3, 2 cents a day, and then eventually 3 cents a day. But that represents more something like 7-8% of their value. These lose a penny a day and they cost $2.28. So the thing is that these lose value much more quickly. The theta is a much bigger chunk of the premium here. And as you get closer to expiration, that theta will actually increase. So then because if you look at something here like the August 2nd, you can see these have a theta of 2 to 3 of 2 to 3 cents, and the premiums are even lower. So anyway, the thing is, as you get closer to expiration, the theta will increase, the time value goes away, and these have less time value. So this strategy essentially does is it benefits from the fact that there's more delta in these calls, and it also benefits from the fact that there is more time decay in the shorter term calls expiring in August. Now, the thing that ruins this trade is that the stock suddenly jumps to 75. Then what happens is these short term calls explode in value, and then a person would essentially be stuck with the difference in premium between the 67.5 between these two expirations, because then essentially they would have to buy these back here, and or they'd have to sell the whole position. So there's not significant risk in terms of the amount that can be lost to the upside because this hedges that. However, this is something that's intended for a slow grind higher, not for an explosive move. If people are looking for explosive moves, a calendar spread is not a strategy that would necessarily work for that. people would look for something like a vertical spread. But I wanted to mention a name like Coca-Cola here. When you look at the overall environment, good earnings, and we're at a spot where you know, um, as inflation moderates and things kind of go back to normal and everything else, they could be in a spot where they benefit from the overall growth. I mean, there seems to be evidence now that our workforce is increasing, our population is increasing, and a way that people can look to play that is something like the consumer staples. Those are names that are going to be more sensitive to the size of our economy and our population than necessarily something even like the Fed or anything like that. So calendar spreads, something people might think about in Coca-Cola. Now, if we look at a name like Alphabet, their earnings were not all that bad. They had the YouTube was weak, but there are other aspects of their business. Research was strong, overall beat. And what's interesting now is they're at a spot where they're way below the Keltner channel. And there is, if you look across here, some areas that people could look for potential support. They might look for the stock to kind of stabilize. And this is now a stock that you might be thinking more about selling put spreads on. Now, the thing about a name like Alphabet is that essentially it's of course a mega cap company, and it's one of these things where now the negativity has happened. The event has come out, the news is out, and this is now a time where one of the strategies I've kind of noticed as a potential thing to think about is that when companies fall on mediocre earnings or so earnings, not terrible, but just kind of like it ran with a lot of enthusiasm, and then it comes out and people just kind of shrug their shoulders. Selling put spreads on things like that is something that can potentially, um, you know, might be something people want to think about because it's at a spot now where the liquidity event of earnings is now past, and the potential of it to have new negative shocks is maybe diminished as to where it was, and something like that will not necessarily have a fast rally. Which means that you don't necessarily want to be spending money to buy options on it because it might just sit here for a while. But if it does sit, then something like selling put spreads is something that people might want to think about. So something like in this name, the thing about put spreads is, you know, because people are selling options, focusing on shorter time frames might be the thing that makes more sense because you get more time decay in that shorter time frame. So in something like Google here, we can look at next week options. And I've noticed that overall, if you kind of look out to that period of time of 1 to 2 weeks, wait, I was looking here at the sorry, the August 2 expiration, a person might look at something like this, and you can see the stock right on kind of 169. And if you look at the overall price chart, its low today is around 167. So a person could sell something like the 167. By that, they could click on like the bid, and then they could go over here. I'm sorry, calls. Let me look at the puts. And it looks like the 167. These are being bid at about $2.50. And then you click on the bid, and then you hold down control and click on the ask, and it would say that basically it's about $1.40 for a $5 wide spread. That is a little, I mean, a premium collecting about a third of the value is often something people use as a kind of, benchmark. But then where is, you know, um, when you think of the risk reward of this, essentially you put the entry price in the stock at $166.10 because you basically look at the strike price of 167 and a half minus the premium collected. It would imply an entry price of 166 and 10 cents. So basically right here, the stock today, I mean, that is essentially right here on the chart. So I mean, this could be an area where people think if it goes down that low, I might want to buy it anyway. And if it suddenly rebounds, then the put spread would be profitable. So a person when the stock is down like this and it's getting to that point when it is getting more oversold, here it is. I mean, look at it over on our price grid. If you look at Google here, it is on its Keltner channel. It is basically minus 68%, which means that it is 68%. It is two-thirds of a Keltner channel below the bottom of its Keltner channel. So that means that at this point is at a spot where, based on average true range, which is the basis of Keltner channel, it could be viewed as being pretty oversold. So let's look over here again at this chart, and you can see here's the Keltner channel, this dotted line, and we're way below that. So that put spread is something people might think about. I mean, that expires next week. So as long as the stock remains above 166, more or less, so 166.10, this is a quick example I wanted to kind of come up with. But this is this sort of thing that in this environment might be something to think about. And then the other one that just kind of grabbed my attention here was Morgan Stanley. Like I said, this is a name here that is at a spot where, remember, financials been outperforming. People are looking for some more IPOs and M&A later in the year, and here it is, kind of holding above this level. And when you look at a stock of this kind of time frame into something like, in my view, September expiration, again, this is now near the top of its range. And if this starts to break out, this is one where something like a longer term vertical spread could potentially make sense. So, I mean, or, at least potentially appeal to people. We look at here at like our September expiration. A person might look at something like, the 110. You could click on 110 and then, I'm sorry, 110. And then something like the 115, that would basically about 80 cents. So you're looking also at something here which has that potential to, to yeah, if that would hit that level, it'd be over 400% potential return from the stock moving about 10%. Can Morgan Stanley go 10% through the end of September? Well, like I said, with this point, with that potential, near those old highs, and having had a strong earnings report, our MT Main that sorry, let me get this back. You can see here, like I said, on MT Main, that financials are actually now, it looks like financials have basically are now the leading sector year to date. Look at that. So all those things out just as the second half is beginning. So if this kind of continues here, that's the sort of thing that might actually, have some, just kind of point that out, because there's the relative strength, there's the chart level, and then you have the, the rotation happening on a year-over-year basis, and you have the earnings report. Put all those things together, and that's just something that might kind of be interesting. I would also just mention something that did notice is that Chipotle Mexican Grill seems like this has been, I mean, one of these phenomenal growth stocks, and obviously it's oversold here, and this might even be something. I have not looked at the options on this, but at this point, this might be an area where people start thinking about selling put spreads on a name like this. But I did want to say that if you look at this, I mean, this is to me a kind of some of the news we've seen in this is potentially, I think, fatal to this as a long-term growth story, or maybe not fatal, but this growth story could be, kind of um, take a pause for a while here. And the reason is, if you look at some of the price action here, this looks like some more significant long-term distribution. And so I want to just kind of mention this kind of false breakout, and then the way it just broke lower. And then the thing is, it has a high valuation. And then they were talking about how having raised their prices has hurt their business. So this is a company that has been on a monster run really for like probably the last decade. I couldn't believe how well it was doing, like coming in COVID. And it's incredible. But I want to just mention that because another one that was coming up on my list was Texas Roadhouse, because this name here, it has run, but if you look at it on a daily chart, basically, here it is near the 100-day simple moving average at the bottom of the Keltner channel, been in an uptrend. Earnings are coming out actually after the close tonight. So this is something that is interesting, because one of the patterns I've seen, and we see it, look at IBM today. IBM basically had this kind of tight pattern, and then, buying the open on a strong earnings report when you have a name in a tight pattern, that can be a potential technique. Another one like that was ServiceNow. ServiceNow basically came out, they were just kind of drifting sideways. But the thing is, when you have the tight period of consolidation and then you get that bullish earnings report, if people are anticipating it and they can grab it right at the open, sometimes those have the ability to extend. Some other examples of that recently were, it was CHKP. This is some kind of cybersecurity stock that seems to be on its own program. I'm not sure exactly of what its business is, but it's been a very strong one. It's had a lot of positive kind of commentary recently. But again, it was just kind of it had this sideways movement, This was like not as long, but if you even look at it, it hadn't done that much really, since kind of March. And it kind of goes back toward its highs and it sits. And then the earnings come out and it extends. But I think right now it's interesting because Texas Roadhouse, people might be want to kind of watching that, kind of seeing where it comes because it's in a similar sort of thing where you basically have had in this name, more than 2 months of sideways movement. And so I want to just kind of, mention this one was coming up to me because, and the reason I found this was because it was recently hitting 52-week highs and it was near the bottom of this Keltner channel. It popped up to me yesterday when I was doing some scans and I just wanted to kind of mention this one. And we've shown you before how to do that, but if you look at the things on our workspaces, you can see stocks that make recent 52-week highs and then get down near the Keltner channel. What you would do is very quickly, you go to price grid, you would look for stocks that recently made 52-week highs, days since 52-week high or low. And then what you would do is you would say, look for stocks, that made a new high in the last month. And then you would look for stocks near the bottom of the Keltner channel and then boom, this can often be a way to find these kind of bullish names that are pushing highs. All right, so I got to go. Remember, we're going to be doing a webinar on Monday. We're going to start trying to do that Monday afternoons at 3, and go ahead to the blog post to sign up for that. Hope everyone has a great day, and I'll see you soon.